Hello, traders. Welcome back to the ComLacro channel. In today's lesson of our course, Technical Analysis for Day Traders, from Basics to Advanced, we get to one of the most practical tools you will ever put on a chart, technical indicators. You already know that technical analysis is the foundation of a solid trading strategy. Today we focus on how indicators help you read market behavior and sharpen your timing. And in day trading, timing is most of the game. We'll cover the four main families of indicators: trend, momentum, volume, and volatility. Each one gives you a different lens on the same price action, and knowing which lens to look through is what separates a confident decision from a guess. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. Before we dive in, here is what to expect from this chapter. We'll look at what indicators are for, how they behave, and the risks that come with them. We won't break down each tool in depth just yet. That's coming in the next lessons, where we'll take them one by one and show how to apply them in real trading. For this video, we'll use TradingView as our reference platform, since it's widely accessible and its free version is more than enough to explore most indicators. Keep one thing in mind, though, platforms can differ slightly in how an indicator is calculated and displayed. So always understand how your own platform builds the tool you're reading. Otherwise, you may be interpreting a signal that isn't really there. So let's start with the obvious question. What are technical indicators? Technical indicators are calculations that help you interpret market conditions by analyzing price movement and trading volume. In day trading, where decisions happen fast, that kind of structured reading is invaluable. And they have come a long way. New methods keep appearing as trading technology evolves. Their main purpose is to help you anticipate where price may go by studying where it has already been. By exposing patterns and trends, they give you a clearer basis for deciding when to enter and when to exit. Think of them as a guide through a market that rarely announces its next move. Now that we know what they are, let's look at how they work. At their core, indicators take historical price and volume data and turn it into something visual and measurable: a line, a curve, a band, so market behavior becomes easier to interpret. Each indicator has its own formula, but they all serve the same purpose: to give you a clearer picture of market conditions, so your decisions rest on data instead of impression. With that in mind, let's go through the different categories and see what each one actually measures. We start with trend indicators. Their job is to show you the market's overall direction. Moving averages are the classic example. They smooth price data over a chosen period, making it much easier to see whether the market is climbing, falling, or going nowhere. That single reading already tells you whether you should be looking for buys or for sells. And notice the trade-off built into it. The more you smooth the data, the cleaner the direction looks and the later it arrives. That delay is not a defect. It's the price of clarity. Next come momentum indicators, which measure the speed and the strength behind a move. The most popular one is the Relative Strength Index, or RSI. It helps you judge whether an asset has been pushed too far in one direction, overbought or oversold, and whether the current move is likely to continue or run out of fuel. Just remember that momentum can stay extreme for a long time in a strong trend, so an overbought reading is information, not a sell order. Then we have volume indicators, which are essential for confirming what price is telling you. Volume shows how much real activity is behind a move. On-balance volume, or OBV, for example, tracks whether volume is building or fading as price advances. When volume agrees with price, the move has support. When it doesn't, you have probably found a false signal before it cost you anything. Finally, volatility indicators, which measure how widely price is swinging. Bollinger Bands are the best-known example. They expand and contract with market volatility. Wide bands mean the market is moving aggressively. Narrow bands mean it has gone quiet, and quiet markets often come right before the next expansion. That reading tells you whether to trade actively or wait. What volatility tools will never tell you is direction, so they belong beside a trend reading, never in place of one. And now, let's talk about how to choose the right indicator for your trading style. The right choice depends almost entirely on how you trade. If you're a day trader, you need tools that react quickly and give you readable information in real time, which is exactly why moving averages and the RSI are so common in intraday work. If you're a swing trader, your priority is different. You're looking for longer-term direction and key reversal points, so indicators like the MACD or volume-based tools tend to serve you better. Before we look at specific examples, there's one mistake I need to address because it's the most common one I see: using too many indicators at once. Open the chart of almost any struggling trader and you'll find the same picture. RSI, stochastic, Bollinger Bands, a couple of oscillators, all stacked on top of each other. The problem isn't that those tools are bad. The problem is that most of them are saying the same thing in slightly different ways. So instead of confirmation, you get noise. And when three tools disagree by a fraction, you freeze. Success in this business comes from simplicity, not from complexity. The more indicators you add, the harder every decision becomes, and the slower you act. A clean chart with 2 or 3 tools you genuinely understand will outperform a crowded one every single time. That's the key idea. Your indicators should support your trading style, not bury it. For day traders, fast-reacting tools like moving averages and the RSI work best. Swing traders usually get more from the MACD or from volume analysis. Choosing the right tool for your strategy keeps you focused and helps you time the market far more effectively. But picking an indicator is only half the work. Before you use one in a live operation, you need to understand how it is built. Every indicator has its own calculation and its own blind spots. Learn what it measures, what it ignores, and what its signals actually mean, because using a tool you don't understand is how good traders end up taking bad risks. In the end, the right indicator is the one that fits your style and your strategy, while giving you the information you need to decide with confidence. Once you understand how each tool behaves, you can adapt it to different market conditions, instead of hoping the market will fit your settings. Now that we've covered how to choose, let's move on to something more powerful: combining indicators. While a single indicator can be useful on its own, combinations tend to produce far more reliable signals. That's because different families measure different things: direction, strength, volatility, and when independent readings point the same way, they confirm each other and cut down false signals. A classic pairing is a momentum indicator, like the MACD, with a trend indicator, like the simple moving average. The MACD shows you when momentum is shifting, while the SMA shows you the direction that momentum is shifting within. When the MACD crosses above its signal line while price is trading above the SMA, you're no longer guessing. You have two independent readings agreeing that a move is developing. Another effective combination is a volatility indicator, like Bollinger Bands, together with a volume indicator, like OBV. This tells you not only how strong a price movement is, but whether real participation is behind it. When price breaks out of the Bollinger Bands on high volume, that's usually a genuine continuation rather than a spike. And that distinction is what keeps you in a good trade and out of a trap. The key is choosing tools that complement each other instead of repeating each other. Two different perspectives on the same market reduce the noise and leave you with the signals that are actually worth acting on. And that's the test to apply before you add anything to your chart. If the new tool comes from the same family as one you already use, it isn't confirming your read, it's echoing it. Now, let's talk about the benefits and the risks of building indicators into your strategy. On the benefit side, indicators bring objectivity. They base your decisions on price and volume data instead of on how you feel about the trade, which makes opportunities easier to spot and easier to act on with discipline. They also filter noise and simplify trend reading, especially valuable when you have seconds, not hours, to decide. And clear, rule-based signals build the kind of consistency that keeps you doing the same correct thing over and over. But the risks are just as real. Indicators generate false signals, especially in volatile or choppy conditions. Most of them are built on historical data, so they lag. By the time the signal is clean, part of the move is already gone. And relying only on indicators can leave you blind to fundamental events, like news releases or earnings reports, that reprice a market in seconds. There's also the trap of over-optimization. Tuning an indicator until it looks perfect on past data creates a false sense of security. Too many tools produce conflicting signals and hesitation, while a good run with a single indicator can breed overconfidence and oversized risk. And without regular backtesting and adjustment, even a good indicator loses its edge as market conditions change. So yes, indicators are useful, but only if you respect their limits. Combining them with other forms of analysis and staying adaptable is what turns them into a long-term advantage. That brings us to backtesting and validation, an essential step that most traders skip. Backtesting means running your indicators against historical market data to see how they would have performed. It matters because it lets you verify that a tool actually produces reliable signals before you risk money on it. By watching how an indicator behaves in trending, ranging, and volatile conditions, you learn where its strengths are, where it fails, and whether it belongs in your strategy at all. Test it on the instrument and the time frame you actually trade, too. An indicator that performs beautifully on a daily chart can fall apart on a 5-minute one, and results borrowed from someone else's market tell you almost nothing about yours. It also builds real confidence in your system. You can see exactly where the indicator would have worked and where it would have misled you. And that knowledge is what lets you adjust before the market charges you for the lesson. Platforms like TradingView make this practical. You can apply your chosen indicators to historical charts, run simulations, and study the results without risking a single cent. That gives you room to fine-tune your approach, test different combinations, and optimize your strategy on actual data instead of on assumption. In short, backtesting validates your tools and refines your strategy. When you finally enter the market, you're doing it with something you have already proven, and that changes how you execute. Now, let's compare technical indicators with fundamental analysis, because the difference matters more than most traders think. Technical analysis looks strictly at price movement and trading volume, using indicators to project future price action for past behavior. It's highly effective for short-term strategies, like day trading, because it lets you make quick decisions based on trend, momentum, and volatility. Fundamental analysis works on a different scale. It looks at external drivers, economic reports, corporate earnings, interest rates, and other financial metrics, and it's mostly used for long-term investment, because it measures the underlying value of an asset, rather than the shape of its chart. Here's the key difference. Technical indicators don't see the outside world. They won't tell you that a central bank is about to speak, or that a company's financial health has changed, even though those events can reprice a market instantly. Relying only on them can leave you exposed to information the chart hasn't reacted to yet. That's why a balanced approach matters. Even if you trade primarily on technicals, keeping some awareness of the fundamental calendar gives you a fuller view of the market. Reading both the internal data and the external pressure helps you decide better and keeps you from being caught off guard. So remember, indicators are powerful tools for analyzing movement, but they work best alongside an understanding of the broader economic and financial landscape. That balance is what lets you navigate complexity with confidence. Now let's look more closely at the most important indicators individually, starting with volume. Volume is one of the most fundamental readings on any chart. It measures the total amount of an asset traded in a given period, and it's critical because it confirms the strength behind a price move. A move on heavy volume carries far more weight than the same move on thin volume. Volume spikes signal a surge of interest and often arrive just before a large price move, which helps you judge whether a trend is gaining strength or quietly running out of participants. Next are moving averages, the most widely used trend indicators. They smooth price over a set period, so the market's real direction becomes visible. There are two main types: the simple moving average, or SMA, and the exponential moving average, or EMA. The SMA averages price over a number of periods, giving each one equal weight. The EMA gives more weight to recent prices, which makes it react faster to change, a real advantage when you're trading fast markets and need the signal sooner. The cost of that speed is more false turns, so day traders often keep a fast average for timing and a slower one for direction. Now, the Relative Strength Index, the RSI, a momentum oscillator that measures the speed and the size of price changes. It moves between 0 and 100 and helps you identify overbought and oversold conditions. A reading above 70 generally suggests the asset is overbought and may be due for a correction, while a reading below 30 suggests it's oversold and could be setting up a buying opportunity. Then we have the MACD, Moving Average Convergence Divergence, which combines trend and momentum by measuring the distance between two EMA lines. It produces signals when the MACD line crosses its signal line. A cross above points to bullish momentum. A cross below points to a bearish shift. That makes it one of the clearest tools for spotting a change in market direction. Next, Bollinger Bands, the popular volatility indicator. They're built from a moving average in the middle, with two standard deviation lines forming the upper and lower bands, and those bands expand and contract as volatility changes. When price touches or pushes outside a band, it can mean the market has stretched too far, a possible reversal or pullback, especially when the move isn't supported anywhere else. Finally, on-balance volume, or OBV, which connects price and volume directly. It adds volume on up days and subtracts it on down days, building a cumulative line. When OBV moves in the same direction as price, the trend is confirmed. When they diverge, price rising while OBV falls, or the opposite, it's an early warning that the move is losing the participation behind it. That divergence is one of the few signals that tends to appear before price reacts, rather than after, which is exactly why it's worth watching. Used well, whether you're reading trend, momentum, volume, or volatility, these tools let you interpret market conditions far more accurately and decide with much more confidence. Understanding how they work together is what turns a collection of indicators into an actual strategy. Now let's close with the most common mistakes traders make with indicators and how to avoid them. The first is leaning on indicator signals without considering anything else. Indicators are tools, not guarantees. They read historical data, and no indicator is right 100% of the time. Taking a buy signal from an RSI or a MACD crossover while ignoring the broader context, a major news release, a shift in economic conditions, is how a technically valid setup turns into an avoidable loss. Use indicators as one part of your analysis, never as the decision maker. The second mistake is the one we talked about earlier in its worst form, overloading the chart, a habit often called overfitting. When you run too many indicators, especially similar ones, you get conflicting signals and confusion instead of clarity. Too much information doesn't make you more careful, it makes you hesitant, and hesitation costs you entries. The better approach is a small set of tools that complement each other. One for trend, one for momentum or volume, and the discipline to act when they agree. And there's a quieter version of the same mistake, changing your settings after every losing trade. If you shorten a period here and adjust a level there each time the market disappoints you, you never actually test anything. You end up with an indicator tuned to your last loss, instead of one tuned to how the market behaves. Master those few tools, test them, and let the market show you when they work and when they don't. That's how indicators stop being decoration on a chart and start becoming an edge. So, trader, if this video brought you more clarity, like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the ComLucro Trader community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, The mission of the Com Lucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts, it's about mindset, discipline, and execution over time. Our main courses include smart money concepts, ICT, technical analysis, trading psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.